Good morning, everybody. This is Jeff Scott. It's approximately, I think, about 8:30, a little bit after 8:30 in the morning on Sunday, November 29th, 2015. And welcome to this week's rendition of my top-down review. I think as we leave the holiday shortened and light trading week and move into December, in the last couple of days of November, the looming Fed rate decision becomes increasingly in the minds of traders. So I entitled today, really looking at the next couple of weeks, will Janet be a Grinch or Santa? Now, I think the other thing that's going to be important this week will be the results of Black Friday and the early results of holiday sales. I just saw on the news that in stores were down 10%. Online, we're up 14%. I'm not sure that those are equal dollars, so it'll all be, though, as everybody knows, is like earnings estimates. It's not the real answer. It's what people thought the answer would be as to whether or not that was a good report or a bad report. My name is Jeffrey Scott, for those who haven't been here before, and my email address, as you can see, is hgsidoc@gmail.com. Disclaimer, this is for education purposes only. Any recommendations are in the spirit of education, should not be considered investment advice. I am a doctor, not a broker. I am truly independent. I have a lot of friends in the trading universe, but nobody pays me to talk about them or talk for them or against them, I should say, as well. And I've paid for all the tools that I demonstrate, and trading involves risks, and you alone are solely responsible for any investment decisions that you make. I like to define my background into two worlds. I started in CanSlim as defined by O'Neill. If you've never read this book, shame on you. This is really the How to Make Money in Stocks, I think, is a great beginner's guide to trading. O'Neill's disciples, Morales and Catcher, took CanSlim into the next millennium with Bible gap ups, pocket pivots, and their shorting techniques. Ian Woodward and Ron Brown for 20 years or more have been taking CanSlim and improving it and making it electronic via HGSI. This is my buddy George Lee, who we do some joint educational programs. And I've taken that background, which is sort of a balanced technical and fundamental style of investing, looking for stocks with growing earnings, buying them at support. And then I married it with the things I've learned from John Person. Lives down here by me. He's become a great friend of mine. Really has some wonderful books as well. Mastering the Stock Market and the older book, Candlestick and Pivot Point Trading Trickers, are two great books. But what's even better is, as you'll see, how I use some of his TradeStation indicators, really makes his techniques even easier to use. John is an educator. He's a trader. As I said, he's a friend, and he's really created some wonderful indicators that, frankly, haven't changed in 20 years, which is something I like. He's not always trying to sell me something new. And then Van Tharp I just put in here because you got to know how many shares to buy, where to put your stops. And when I do my charts of the week, I talk about those specific things. I have a lot of programs. I purposely kill my desktop because I don't want to distract you, but I need TradeStation and Thinkorswim. I use both of them on a routine basis. Genesis Trade Navigator is probably the best charting program of the bunch. It's not cheap. I pay for data, and I recognize that not everybody's going to invest in it, so I don't use it during these programs. HGSI is my post and intra-market analytic tool. EdgeRater is another analytic tool that I use mostly end of day. Seasonality, I'll probably look at one of these programs today. I use a number of them and then a number of websites. So I always start by taking a snapshot of the market and just getting an idea what was working, what was not working. This is something that John actually put together for his package, and it's not very difficult. I took out his indicators for this picture, but he built lists of the key stocks in the major sector groups here, so you can get a sense of what's not working, what is working. Well, it's pretty easy to see materials were weak on Friday. Energy, the XLE, the XOP, oil gas production, and services were red all through them. That's weak. Financials, and they actually look pretty good this weekend, especially the regional banks, the money center, the regional, the insurers, and even the broker-dealers had some strength, but not the credit cards. Looking through, industrials looked mixed. Staples looked fairly strong, but discretionary was weak. Retail going into Black Friday, mixed at best. There's been several like Abercrombie & Fitch that I found using John's tools that have had a really nice move over the last week or so. Utilities, more positive than not. Healthcare has been the strength of this recent market, especially biotech. Gold continued to be weak. Now, why do I do this? I do this because I can look at the market anytime intraday and get an idea what's working, what's not working, and a sense of the overall market. When I look at my Thinkorswim screen, looking at the E-minis, the Nasdaq futures, the YMs, the TFs, the Russell futures, then the VIX futures, and then lastly, the dollar futures. The first thing you should, and this is weekly charts, is you should see that we've retaken the yellow line on all the major indexes and just about on the Russell, which is the 50-day moving average. So if you use the 50-day moving average to help you determine whether you're in an uptrend or not, we have retaken it, even though we tested a couple weeks ago on several of the indexes, we have retaken it across the board. The VIX remains elevated compared to where it was for much of this year, but it's still come down quite a bit. And the dollar is slowly inching higher, which may in some ways help American stocks that are traded only domestic. Strong dollar is good for the marketplace, for the economy in some ways, but it will hurt, and this is where the strong dollar is bad, those entities that do much of their sales outside the U.S. Now, the perfect world is you buy commodities using expensive dollars and you sell them in the U.S. where you can take advantage of the strong dollar. But if you sell your product outside the U.S., it becomes more difficult. And then the same picture in Genesis, the E-minis, the NQs, the TFs, and then the NYSE and the YMs. And what I wanted just to point out is that we are in uptrends across the board and in buy signals across the board. The only thing here that doesn't have a buy signal is the NYSE. And, those are called railroad tracks here on the NYSE. It didn't do much on Friday. But the NYSE is probably close to triggering a weekly buy. Everything else is in a buy daily and weekly. So the thing about the debates about the rates, no pun intended or no rhyme intended, is that interest rates on the week were really flat. They were minus 0.31%, so really didn't do much, or minus 7 basis points. You look at the trend since 2007, 2008 continues down. I could probably draw a trend line here that we haven't violated. I think they raise. John, who is much more knowledgeable than me, doesn't think they raise because it's December, and that really would be the Grinch raising rates, especially on folks that are struggling to survive. Then again, if you're living on a fixed income, some rate increases would be good. With the 10-year treasuries trading at 2.25, does it really matter if the Fed raises 25 basis points? Does it really matter if at the end of 2017 the Fed goes to 1.25%? I don't think it does from an economy perspective, but it does a lot from a mental, emotional perspective, that once the Fed start raising rates, will they overdo it as usual? And remember, falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders, and rising rates are good for banks and insurers. Now, what's interesting is there was a bit of a, I guess I would say, divergence between what I saw in the stock review this week and those two lines, and that REITs were very strong this week. And so were banks, especially regional banks, and a number of the insurers. And how do you balance that? And I guess in my mind is that a small rate increase might be good for banks, will be good for banks. But as long as people believe it's going to be the Goldilocks phenomenon of just right, maybe REITs will maintain because of their much higher interest rates. Now, MLPs and their lower, the fact that back on the REITs, the cost of borrowing is still low. Home builders, led by D.H. Horton, look strong. But other than that, especially utilities and MLPs did not jump off the chart with any strength on my weekend review. If I look at advanced decline lines, we continue to slowly trend up. We peaked, we pulled back, we're heading back north, which is good for the market. I look at market participation. As you can see on the weeklies, we turned up again on the number of stocks above the 200 and the 40-day, telling me that the market is having better participation. Canaries in the coal mine are staying at their new highs, sort of setting up a high base. These guys really have led the market. Kramer talks about FANG, and it's true right now. Priceline's not working. Tesla's been up and down. But the others, including the 2As, Apple and Amazon, have certainly been leading this market higher. Amazon perhaps less, more so rather than Apple. So market thoughts, the left is updated, the right is the same. Short term, we're climbing a wall of worry. We got through the Paris attacks, the concerns in Brussels, worldwide weakness, rising rates in the U.S. on the horizon. Will Fed speak, turn to action soon? I think there's a good chance. And what's working? Well, clearly biotech over the last several weeks have been on fire, as have been a number of specialty pharma, home improvement. I mean, fortunate to have some Home Depot and Lowe's, as well as a lot of the companies that make supplies for them and builders are up. Home builders had some strength. LGIH and D.H. Horton probably leading. Regional banks, REITs, and then the FANG stocks may not have had a great week. I don't think they had a bad week, but those FANG stocks are probably what I will use to determine when this market is done. FANG's an acronym made popular by Kramer, but the concept made popular by Ian 3 or 4 years ago with the Canaries. Longer term, I still like to look back at 2001. We're not at new highs yet. You know, the abruptness of this correction is probably over, but do I believe we got another 6-year bull market ahead of us? No, I think next year may be challenging. I think the slowing economy in the world versus full employment in the U.S. does put the Fed on a hot seat, especially if we see any element of inflation. Risk management, always prudent, and these are the months where we expect to have bottomed and go higher. Remember, stock patterns are cyclical, and it's almost as if we've taken this pattern and truncated the top third, and we've been living in a sine wave where every time I think this market is done going up, it goes higher, and when I think it's done going down, it goes a little lower. But I think I said that backwards. And then every time it pulls back, and instead of having a deep pullback, it turns up, and it keeps going up. And when I've gone high, when I'm up here heading up, it seems to turn down. So it's sort of like a sine wave, a truncated version, sorry for screwing that up, of the typical pattern, and it's happening quickly up and down, which it's been doing for most of this year. It's tough to really adjust your trades based upon that quick changing of the market direction, but I am making my choices based upon where we are, and I am, because of the seasonality we're at, where the way this market's been doing, I'm much more in this left-sided camp of more aggressive, but wary that this market has been one that we've not seen long bull or bear moves this year. News-wise this week, it's the first Friday of the month, so non-farm payrolls will be probably the big number. And I think these numbers become bigger than they are normally because I do believe the Fed wants to raise rates, and I believe that strong numbers this week will give them all the ammo they need. I think that if the numbers are weak, they'll be pressured to raise rates. If the sales numbers for the Black Friday are horrible, perceived, that may give them pause to reconsider. But of late, we've been beating to the hot side, and so again, as always, these are important, even more important. Now, looking at this, you can see there's not a lot of earnings this week. However, there's a few that people probably may have interest in. Quihu's been a big move off the bottom. Is one that popped out at me. AVGO, one that I've been in and out of. Kroger's, Ambarella. So a number of stocks, Ulta salons, or Ulta, the retail of the salon stuff, things that guys don't really shop at except to buy gifts. So some big earnings, but not many earnings this week. Usual agenda. Now, I've been doing these charts of the week for fun. As it says here, these are educational purposes only. Trading, especially if I talk about options, which I'll talk about at the end today, carries substantial risk of loss. I do not warrant any expectation of return, and I may or may not already have a position in the stocks I present. I will take the trades if they execute so I can discuss. And I'm doing this not to provide stock tips, but to openly discuss how I take the trade, why I chose a specific stock or option strategy, and where I would plan on taking profits or placing stops. Last week I looked at CONE. One of the PUG members actually sent an analyst report out that came out Monday where they also liked it. This is what I call a Jeffrey stock. It's a clear uptrend, lower left, upper right. It's a little loose. I'd rather it be a tight line. But lower left, upper right, pull back to the 50-day moving average where we had a PSAR reversal a week ago Friday, OBV breaking above its moving average, and a kahuna. All my technicals up top turned green, and I had a mobile breakout out of a recent squeeze. I love the earnings per share growth, and it paid a 3.6% dividend. So I looked at this stock, then I went to TradeStation. I saw that it had a PPS buy on the daily, and it was in a weekly PPS. The pullback on the weekly, now the daily buy. OBV, very strong, up on the weekly, breaking above its moving average, as we saw in the HGSI chart on the daily. My three bongos, the daily, weekly, and monthly, were now green, the daily just turning green, and this tells me it had a pocket pivot, a mobile breakout the day before. The PSAR just reversed, and the kahunas and the force were both green. The force kahuna was green. So it met my criteria for a trade. I said if the market was stable, which pretty much it was last week, that I would buy if it took out the prior high, or most recent high, which was 35.50. Actually, I set it right above the last conditional change for those that follow John. And my target would be 37.20. My risk would be 33.80. That's a one-to-one trade. Typically, unless there's a reversal off of here, I will take profits at the one-to-one, raise my stop to break even, and let the rest of it ride until it violates, either gives me a sell signal or takes out my stop. I was risking $1.70 a trade, or about 5%, and I could buy 1,200 shares on a $2,000 risk. So what did it do? It took out my buy signal on Tuesday, closed below my buy on Tuesday, and moved up Wednesday and Friday, up about 2% on the week. It's still in a squeeze, hasn't violated anything, and I'm still in my position. We'll come back to this later, as well as my pick for this week. I like to look at Excel to just get a sense of what the week did. So what I'm doing here is I'm taking a list of user groups that I create, download, copy, steal. I don't steal anything. I shouldn't say that. And what I do with this list is I get a sense of what they would have done if they were static from the close of Friday last week to the close of Friday this week. Only thing I filtered out were user groups, indexes rather. First thing you notice is there's a lot more black than red. So it was a very strong week. We noticed that, interestingly, S&P 500 was up just a teeny bit. So the S&P was actually flat on the week. Now, that surprised me a little bit. I thought the market was up more, but even on this, from open Monday to close Friday, it was up only 0.03%. So relatively flat week in the market, at least as calculated here. The best of Woodward and Brown, the IBD 50, and the HGS 100, which is somewhere in here, all behaved about the same. HGS 100 actually was up 2% compared to the IBD 50. It has 57 stocks in it. So growth stocks did kind of on par with the S&P, with the HGS 100 actually outperforming. My buy watch looked just like the IBD 50 from a percent return, with 70% of the stocks positive. However, the stocks that I owned going into the weekend were up 1.78%. And then I take my buy list and I filter it for person signals, and you could see they were up 3.21%. And those are the ones I trade for the week, are the ones that make it through those criteria. And then I put this here not because I own these, but because 2 weeks ago, beta stocks got hammered, and high beta stocks were up 5.54% on the week. There was no Hindi. I don't expect there to be a Hindi until we get to new highs, so we don't need to worry about that. Those who are newbies, a Hindi is a signal that we see in the market when it gives you sort of a premonition of a potential top, where the people, the pros, are selling out their shares to the amateurs, us, and we're buying them hand over fist as they're getting out of the market. When this signal occurs, there's a reasonable chance that you're going to see a pullback. Most of those pullbacks are slight, but all major corrections over the last 50 years have been preceded by a Hindenburg signal. Bucketology, 69% of the stocks in the S&P 1500 are above their midline. But as I look at where they fall, most of the stocks are in the middle of their Bollinger Bands, or not a very extended market. The markets we're just now concentrating on this area here. The markets had been in a buy mode. They got shaken out about November 12th. You had kahunas across the board on the 18th and stayed neutral this week. Again, the S&P was very flat, but a couple of places of interest coming up, and it looks like those are in the Russell was leading us up this week. I'm going to look at seasonality real quickly. There are some great stocks out, or great seasonality patterns right now in the market. So what I like to do is I run Edge Rater. I use seasonality in a bunch of different programs. So I'm a seasonality fan, but this is sort of the quick and easy way of doing it. So I ran seasonality and Edge Rater, and I can see, interestingly, that a number of these REITs are up at the top. But these are some of the stocks here that over the last 20 years have had a lot of positive years. So if I was a seasonality fan, which I am, I might want to look at stocks that have high seasonality. So what this means is First American Corporation, which is a specialty finance, I believe, or insurance, has been up 18 out of 20 years with an average return of 10%. I'd much rather be fishing from that kind of a pattern than, well, let's see if I can get to where I want to get. There we go. Than to be living in the world where I have a negative historical returns. Now you notice there's not a lot of things with big negative returns as far as number of years down over the next 4 weeks, because we are going through a very strong part of the market. In fact, if I move over to the right, what I've done here is I brought the best of the best up here by eliminating anything with more than 3 more than 3 down years. You had to have at least 8 up years. If I keep going down, here's what I wanted to show you. Ultra short Russells. So Russell short ETF has been down 8 years in a row, 14% down. Russell regular ETF short down 8 in a row, 9% down. The Dow shorts down 9 in a row. The S&P shorts down 9 in a row. The Q shorts down 8 out of 9 years. The message there is simple. This is a time of the market where it would be unusual, not impossible, to see a poor performance in December. December is usually a very strong month. Now I like to jump into TradeStation and very quickly look at my timing workspace, which I forgot to open up already. So let's open it. Let me open up a couple, but let me open up that one first. So what we're going to look at here are the major indexes applying John's stuff, as well as I liked some of Alexander Elder's indicators as well. Specifically, I'm going to use 2 of them that I find to be helpful. So this is not what I want. Let me just switch it to an index. Perfect. I haven't looked at this yet. It's early Friday or Sunday, but it's pretty strong looking. I'm looking at a couple of things. The little green and red arrows are easy to figure out. Those are person buy and person sell signals. This is daily, weekly, and monthly. I'm also looking at the color of the paint bar. That's an elder signal, where an elder signal that's green means it's okay to buy or hold. If the elder signal is red, you should be shorting or holding. If it's blue, you can do what you want. We're not yet in high jump territory, but I might look down at the high jump looking for any evidence that I'm overextended and above 90%. And then I could look at the MACD closely, but all I really need to look for are these little dots here that occur attached to a price bar. Red dots above price tell me that I have some MACD divergence. Red dots below price tell me I've got convergence or positive divergence. So I look at the Nasdaq. I see it's in a daily, weekly, and a monthly buy. Everything is green. That's a strong buy. The Dow Jones Industrials, not quite as strong, but still the same pattern. Everything is green in buy signals. S&P 500, interestingly, has not yet flipped to a green buy signal, but it's in a buy signal on the daily and monthly and a green paint bar. Still very bullish. And then the YMs, the Russell, very bullish. So my indexes look very good. The Nasdaq 100, which has certainly been a leader in this market, you can see it's been in a buy signal going back and maintaining that even with the August 24th flush in the marketplace. So they look great. Very quickly, materials all go blue on a price bar, but person buy signals throughout. Notice these red dots telling me that you may be getting to a period of MACD divergence. Now, why would I say there's MACD divergence? At least the closing high, you probably did make new highs. You did get new highs here in price. You barely and hardly at all broke the zero line here. So your MACD is heading down, your price is heading up. That's usually a sign that you're going to have pricing under pressure. But right now, except for that, the XLB looks pretty good. Energy, a red bar on Friday in a sell signal weekly and monthly. So energy struggles at this point. And you could see that on the weekly review. There were not many energy stocks. Financials, as I said, the regionals look good, and you could see we're in a buy signal throughout. The industrials, blue bars here, but on a green person buy signal. Technology, buy, buy, buy. Staples, it's a MACD divergence on the weekly, on a sell signal weekly and monthly. So Staples had been weak, but had a nice run over the last 7 or 8 days. Utilities, now that's actually a good signal, I guess, if you're long the market. If utilities are rolling over, that might show more risk appetite and equities are being bought. But you could see we're in sell signals throughout on utilities. Healthcare, especially biotech, leading the market higher. And the daily and the weekly look good. You're still in a monthly sell. And then XLY, which is discretionary. You got some MACD divergence. Again, newer highs, barely breaking the zero line. So highs a little bit exceeded. MACD way behind. Hence, you've got some divergence on both the daily and the weekly. When I see those divergences, it's not unusual for that instrument to either correct some or slow down. All right. Now let's go into HGSI. Open up a warehouse view. And let's go into user groups. Top-down view, which is all price and volume, most heavily weighted towards one day. And we could see leading the market higher is the Nasdaq Biotech. I look at this, gold, volatility, oil, silver, commodities. Down on the bottom that says growth stocks were probably in vogue, hence why I had a good week. And that Nasdaq and small stocks are leading the market higher, especially the biotech. So let's go start with the S&P 500. There were no kahunas last week, so I'm going to get out of this view and look at purely a moving average view. So a couple of things up here. These are bongos. These are my long-term timing signal. They are slow, but I don't usually like to buy long when the weekly bongo is red because it's usually red in a long-term downtrend. If the weekly bongo is green, then I'm in an uptrend. And if the daily bongo goes red in a green uptrend, a weekly, that tells me I'm in a pullback in an uptrend. Since I like buying pullbacks, I scan for that signal. These are the Hindenburgs. The last Hindenburg dot was in July, or June rather, so not an issue right now. It doesn't matter what my charts are that I'm using at a given time. I use a magenta as an 8-day exponential. This is from Bigelow and Ricky Wayne, I believe his name is. But notice how the stocks track right up the 8-day exponential. On the way up, when they break below it, it's a downtrend. And they break above it, they resume their uptrend. It's called the T-line, and those two use this as a trading signal or a filter. That's the only exponential. The green 17, the blue 50, and the red are 200-day moving averages. So S&P 500 has broken above its moving averages. There's nothing here in moving averages to keep it down. It remains below prior highs. So if I open up my drawing window, click on that, come to the high here, hold the shift down. That would be prior highs. We have a ways to go. And that is my target on this run up there. We'll see if we can move our box up now. And at some point, we're probably going to be threatening old highs. Right now, I would say we're in a neutral position. We've got support underneath. We got a target up here. One would hope that the 17-day and the 200-day provide support. The 50 comes to catch up, will give more support. We did knife through support on the daily chart on the S&P a couple weeks ago. But we did have a pretty nice bounce as we got close to the 50. So S&P 500 looks pretty good. Next thing I'll look at is the Dow Jones Industrials, which we knew was down here near the bottom. The Dow looks like it's holding its own, looks a lot like the S&P 500. Within the Dow, I have utilities, which I expect look weak. They're below the 17 and the 8. Not surprised from looking at all the stocks. Transports, on the other hand, because of airlines, and now the truckers are starting to move, are sort of held in limbo between the 50 and 200, but look a lot stronger than the utilities do. Take a look at the Russell. Russell's going to have to break above the 200-day moving average for me to become a believer. We've got a long ways to go to take out old highs in the Russell. A little bit less than 1,300. We still got to take out this 200, which might be the short-term resistance. And then I take a look at the Nasdaq, And the Nasdaq, again, like the S&P and the Dow, sort of in a trading range now, hopefully between the prior old highs and the 200-day moving average. Notice the 50 is moving up quickly to retake the 200 and provide hopefully additional support. The real strength of this market has been in biotech, but the biotech, now again, how can I say strength when it looks like this? It's still below the 200. I got to look at where this came from. If I go down here to the low, to where we closed here, we're up about 20% in 2 months trading. Biotech has had a big move off the bottom. It's going to potentially run into resistance fairly soon as it starts to approach its 200-day moving average. So, markets look to me like there's no screaming buy or sell signal. The trend is your friend. The market's trending up, and I see no obvious reason on the charts to say that that's not going to continue. I am aware that those 200 days on the Russell and the Nasdaq Biotech could be some resistance. I then want to look at the dollar, the VIX, and then the metals. So the dollar, you know, it's not really moving that much. It gapped up here on the 6th of November. I think that's when we had a very strong employment number, and people started to assume that we're going to raise rates. And you could see since that time it's up a little bit, but it's gone from 25.8 to 26.1, the UUP. So it's had a little move, a 1% move or so, but pretty much not a gigantic move over the last month. Since the gap up, I look at the VIX. This tells you that the volatility, at least here, again, it's not quite down to where we were in the summertime, but over historical basis, let's open up a monthly chart, we're down kind of near where the VIX likes to fall. So the VIX, when it starts to rise, I'll be nervous. Right now, the VIX isn't an issue to me. Gold, despite the fact that dollars only slowly moved up, continues to fall. Big gap down on Friday. And silver, not so much of a move down on Friday, but also a weak metal. Now I've had a sense now what the market's doing. I looked at the sectors earlier, saw which were weak. Let's look down at industry groups. So I changed this to a 0.7. You notice we have 173 industry groups. Let's tell you what's working right now. I've ranked them by 2-day force. The first thing is I got 74 to the upside. If I look at 2-day EMA to the downside, I've only got 10. Just to very quickly look at what's to this 10. Oil exploration, gas and services, agricultural chemicals, diversified chemicals. So 4 out of 10. Precious metals, no surprise there. Property and casualty, weak. Aircraft and parts index, and then apparel footwear. All right, let's go back up to what's moving now. Let's look at some of the top groups. So I right-click, change index group, and I start to look at these very quickly. Let's change it to my stock view. So you've got this down pat. Now I'm going to change you to my webinar views, and it got a lot messier. A couple things to point out. I have on top is my weekly bongo, followed by my daily bongo. Then I have accumulation distribution, 13-day force, and 2-day force. My high jump bar, and then I got 3 bar looking for little signals. I got Bible gap ups, squeezes in yellow, and mobile breakouts. This here are pocket pivots. Blue is up, red are down, OBV compared to moving average, and then my kahunas. In addition to the moving averages, which we've already reviewed, I've got PSAR reversal dots, and I've got in dark gray the industry group strength. So Allergan is now a arbitrage play as it's doing a reverse acquisition with Pfizer, so they can move their tax base ex-US. I don't usually play those because it's hard for me to figure them out. So we're going to skip Allergan. Eterna's AEZS, we'll use it this way. Everything turned green up here, had a big move off the bottom, had a reverse split, if I remember correctly. Price of the stock could be traded. I usually stay away from reverse splits. I think that's what it had. Let's take a look at more info from Web. FinViz, I love this. It'll open up right here. And what does it say? All right. I can't figure this out, but I already see something I don't like. Consolidation of various share types, so they increase the number of shares. Here's a part that really worries me. I'm not saying anything bad about him because someday he might be a customer since he's now in the pharma and biotech industry. I saw the name of the guy that's Shirelli. I don't want to. Oh, maybe it was on CalBios. All right, so this is a different thing. Okay. I'd stay away from stocks led by this guy here for now. He may turn out to be a genius. I think money's still out, this Scarelli guy. But he's hurt a lot of small investors. Just take a look at what's happened with CalBios and stay away from that one as well. So something interesting from a corporate perspective occurred here. I don't know if it was a reverse split, if they just turned debt into equity. The stock started moving. I'm not going to come close to touch this. Relipsa, I like this pattern a lot. It's coming off of a deep bottom here that has, it's already had a big run, which is the problem. It's doubled. Doesn't make any money. Very much in demand, 4.8% demand over supply. Anything over 2 is really in demand. I might want to look at this more and understand it, but it's had a big run, so I probably would not get too excited. Endo Pharmaceuticals has got that 50-day moving average. Baxalta is being talked about in takeover. Anacor, expensive stock, one of my favorite patterns though. Big run up, pull back, let the 50 catch up to it. Mostly green up above in a squeeze. I don't love any of these. I do love this one. Here's one that I own called Eagle Pharmaceuticals. I think we talked about last week. And the reason why I love this stock is it's only got one quarter here where it made money, and that's because they did a deal in the March quarter last year. They have a number of products that are likely to go before the FDA over the next 2 quarters. You could see this is reflected in some earnings here and earnings here, which will be actually sales and not royalty payments. Stock pulled back to the 200, broke above the 50. I would have talked about it here. Clearly going back to retest old highs a little bit over 100, Eagle Pharmaceuticals. Radius Health has a really new, interesting, novel therapy for osteoporosis. Should be approved, I would guess. Also going sideways. A lot of risk here with one product going in the pipeline right now, close to approval. They've got other products as well. A lot of people like Cambrex breaking out here to new highs. You know, kind of a cup and a handle, pocket pivot breakout. Everything is green. This is one of the nice stocks. None of these, to be honest, except for Eagle, are screaming buys. Even this one's a little bit extended. And no surprise, this group has been leading for some time. Biotech. Talk about bad luck. Clovis had a FDA required more information on their most close to market product. Went from 102 down to 30. Had a big move this week off the bottom, but it's off the bottom. 10% move after people lost 90%. Not much of a difference there. Look at the demand, though, in this stock, 7.2%. I bought some of this after it tanked for a flyer. It's not an investment, it's a gamble. But it's all it is a gamble, because it may take a while for this stock to actually grow again once the shock of the FDA letter is digested. Bluebird looks like it's flying again. Uptrend, pullback, pretty deep on some trial results. Now broke above the 50 at a PSAR reversal. OBV has turned positive. It's not a cheap stock. Looks like it wants to go higher. Gilead, gosh, if you got rewarded for curing things like hepatitis C and changing HIV's natural history, you'd expect the stock to be doing well. I think everybody knows this company. If you look at a monthly chart, a great mover since the late 90s. If you look at a weekly chart, you'll see it's sort of been doing nothing now since the approval of their hepatitis drug in 2014. Poster child for expensive therapies, getting a lot of grief, and that's kept the stock from growing up. The worrisome thing here to me is that the earnings per share growth rate is slowing down. It already trades at a low multiple. I love the company. I just have a hard time recommending the stock until it breaks one way or the other. It's just not rewarded. Insight, this is a beautiful small biotech. They do have a commercially marketed product. They've had a big run up here, pull back to major support on the weekly. This is what I try and pick off when it comes down to the 200-day moving average. I think this will be a winner, and if you look at it 12 months from now, I think the stock will be a lot higher. It's not on its current revenue and earnings. It's on its pipeline, which is one of the strongest in the industry. Alexion, deep pullback, has retaken its moving averages, wants to go higher. Sarepta, this is one of the two companies, this and BioMarin, that are closest along in treatments for muscular dystrophy. They sold off on, I thought, a misinterpretation of an FDA request for a AdCom meeting where they have an advisory committee for BioMarin. Sarepta did not get one of those requests. It's probably too early. And Sarepta sold off, and then this week the AdCom was negative towards the BioMarin product. And you can see price shot up. The FDA is going to be under, I think, a lot of pressure to approve something in MD. And you could see that when it looked like their competitor had some negative news, Sarepta came right off the bottom. Now, I know I pointed this out over the last couple of weeks. It was a compelling buy sitting on the 200-day moving average. You had a buyable gap up here on Friday, the previous week. It could have been bought, and you could still be in it. I'm in it long. I think I mentioned last Friday that I was caught on the wrong side of a put spread, and the move on that Friday basically saved me a lot of money. The other one I mentioned, I think last week, was Celldex. Celldex had some positive data come in for a treatment for brain cancer. I mean, the reason why the stock has moved up to where it's at is because of that data. I think the FDA is going to be all over them in a positive way, because there really are no good therapies, at least systemic therapies, for patients with brain mets or primary brain tumors, glioblastoma multiforme, which is what their data was in, and they have a vaccine for that. So you notice that every one of those companies I showed you, except for maybe Eagle, were stories, not earnings driven. If you invest in biotech and specialty pharma, you have to be aware of their news. That includes when our launches, when our decisions in the FDA, when our decisions on competitor drugs. You have to know when the major medical meetings are that data can be released. So biotech likes to give and it likes to taketh away. You have to know when the news event is. NXP Semiconductors, down a lot, moved up off the bottom here from the October lows, right below the PSAR dot. It's kind of too much in a downtrend for me, so I passed. I do like Skyworks here. The difference between this one and NXPI, it's put in a base here, and looks to me like it wants to go higher. This could be, again, on a plain trade where you could set a buy stop above that PSAR dot. You've got about a $10 run, and you can set your stop not much below the low of this bar right here. That, to me, was one that I considered but did not take for my chart of the week. AVGO, I like this one a lot. The problem is it's been riding this squeeze now for almost 2 months, so a lot of energy is building up here. Its earnings are due out on the 2nd, so I decided to not take a flyer on this. My guess is it breaks to the upside, but that's only a guess. It could also break to the downside. Universal Display, I don't like this. It's already broke out, and it had a shooting star on Friday, which I can't buy into that bar. Analog Devices, going sideways after some initial run back here. It's going nowhere. Freescale is about to be acquired, I think, by NXP. You know what? Let's look at Ambarella. I'm sorry. This is going to be a long one. I can see that already. My apologies. Ambarella's pulled back here and broke above the 50. I actually started thinking about nibbling here, group strength, and then I looked up here and saw earnings of this week, so I passed. I just wanted to point out the earnings date. IT Services, I don't have any idea what this stock does. I just know that it's hard for me to buy a stock that's gone from 5 to 10 in a week, so I'll pass on it, and then everything else is below the index. REITs, I mentioned, were strong. I'll show you a couple of my favorites, at least from a charting perspective. The top is Host. Hard to love this. It's in a downtrend. It does pay a 4.8% dividend. I guess one of my favorites is this CubeSmart. This is almost a tight chart, certainly tight ever since July. Lower left, upper right, breaking out to new highs. Everything is green. Great earnings per share growth. Supports a 2.2% dividend. That's a beautiful chart pattern. If you want to play the last week's chart of the week, not quite tight, but lower left, upper right. As I showed you, I'm still in it. It's up 2% on the week. Everything is green here. Great earnings per share growth, pays a 3.5% dividend. And then some of the medical. Look at the dividend, 4.5% on this one. 5.6% on this. So REITs pay a nice dividend. The fact that they're as strong as they are suggests to me that people either don't think there's going to be a big price, a interest increase, or if we have one, it won't be one that will be every meeting for the next 5 years. MPW pays a 7.3%. Electric power equipment, this is all about Eaton Corporation. Have no idea what they do, except they're in this group. Industrials, everything is green. Move off the bottom here. Makes money, but no earnings per share growth. Pays a 3.8% dividend. I like growth, and I like stocks that are above their 200, so I would pass. I know the next one is the industry group, so we're not going to go look at things that are performing weaker than the norm. Packaged food. Tyson's had a big move over the last 5 days. It's gone. Not even worth talking about it. Boulder Brands, looks like it's a takeout. Hormel Food, nice move up. I'm going to talk about this guy for a minute. I have a long position here. Cal-Maine Foods has been taking advantage of some abnormalities in the chicken world and the egg world related to, I think, one of the chicken flus, bird flus. It trades at a multiple of about 10. It has great earnings per share growth, huge percentage earnings, pays currently a 7% dividend. Despite the sideways pattern, it's lots of demand. And why I like this, let's just take a look at seasonality on Cal-Maine Foods. It's in the middle of a green zone here. So let's just take a look at what it's been doing from this point on. So it's been in a trading range. It's heading up. It's in a November 16th to December 25th, 10 years up, 0 years down, 11.4% is the average return. We're in the midst of it. I like Cal-Maine. It's in a good group, and I love its dividend. If you own it options, you don't get the dividend, by the way. Application software. We'll look at a couple of these, look interesting. CPSI did a transformational acquisition. The move's in. It's already run up to its targets. Unless you knew this in advance, you couldn't take advantage of it. Viva has been a stock that's been, to me, frustrating for a long time. It's been going sideways for the better part of a year and a half after an IPO that it sold off from its IPO highs. It just had a nice earnings beat, which is why it moved up with a viable gap up. It's got good earnings per share growth, still trades at a big multiple, but Viva is starting to wake up. Data had a good earnings beat here, still has to get above that 200. You can see the group strength in dark gray. Athena Health, a nice growth stock in the medical records, transcription, billing and collecting, revenue cycle management, everything's green there. It gets a huge multiple from Wall Street. And then lastly, well, two more e-commerce. So Netflix, one of the FANG stocks, would have been nice to have bought it cheap on the August 24th. Thanks to John Person in his chat room before the market opened, I did put some orders in around 90 and got filled. So I had a nice little run there. Netflix tempting to break out to all-time highs. It's got a little ways to go. Looking at seasonality on Netflix, of course, this will be the year it doesn't work. But this is perhaps one of the best seasonal plays of the year. Starting mid-January here, so sometime around the 19th of January, you go into a period of time of 10 and 0 with an average return of 30%. Until that time, 5 and 5, meaning half the time up, half the time down. So Netflix getting ready for its seasonality star period. VIPs, earnings sucked, but the stock moved up anyways. It's got to get above the PSAR dot. Alibaba, great earnings. Looks like the 200 days holding. Maybe this will be a place it builds from and goes higher. It does have some earnings coming into the stock. And lastly, banks. Again, these are the regional banks more so than the money center banks. And we'll just look at a couple of these. Citizens Financial Group pays a small dividend, makes money, broke above the 200. Here's the group strength. Huntington Bankshares looks the same. PNC, the same. Regions, the same. So we had bought, as one of our stocks of the week a while back, CSFL, and what a beautiful chart this turned out to be. Lower left, upper right, and tight. It just doesn't move much, but it has great earnings per share growth, pays a small dividend. I've been playing KRE as well. Not quite at new highs, pulled back a little bit. This is an ETF for regional banks. And then the other I've had a position in is Ozark, which has been a great performer as well, plus the CSFL. That's our top 10. Now let's take a look at some of my buy choices and see if I have any comments upon them. And then I want to talk a little bit about my process of how I use and filter my buy list. So this was the buy list that I came up with from doing my top-down review. And let's just look at what industry groups. We've got a bunch of specialty pharmas, no surprise. Some of these like ANIP are really roll the dices. I've got my semiconductors that we looked at. MaxLinear was a high-risk buy that I took not long ago, sort of in a high base or a flag. I thought it was breaking out of its flag, and then it came back into it. I still like MaxLinear a lot. Look at this earnings per share growth coming into the stock. Then I have my REITs. Several of these are medical REITs. Outdoor media, what I liked here was it's coming off the 50, had a pocket pivot, mostly green up here, pays a 5.8% dividend. I kind of like it's coming off of a place here where pretty good support at that 50-day moving average. Then we get into some healthcare service stocks. Ones that do the research that outsourced look good. I thought Kroger was going to be my stock of the week. Uptrend, sideways since April, digesting an acquisition, Mobo breakout squeeze, Kahuna got all excited. This was my pick. And then I saw earnings are December 3rd. Don't buy stocks right before earnings. And then other one that I liked was this installed building products. Uptrend, pulled back to support, broke above the 50. OBV looks great. I'm all excited. And then I saw it, average volume 174,000 shares. I can't take it. So these were some of the stocks. So now I do is I take this list of stocks and I go into TradeStation. Now let me open up my screener. And I basically drop those stocks into a list and I go one at a time. Let me reset this. I do this on a different computer, so every time I move this, often have to do a little bit of adjustments because of the resolution's different for when I do my webinars, or else you would not be able to see anything and would take up way too much space. So, do a really quick education about a couple of John signals. This here in orange, so weekly chart, a YRCW. This is a high closed doji. A high closed doji is defined. Stocks in a downtrend. It's kind of going sideways, but I'll give it a little poetic justice that it was in a downtrend. During a downtrend, you get a doji bar. If within 3 bars of that doji bar, or 2 bars of that doji bar, you take out and close above the high of the doji, that is a high closed doji. Now those that are traditional candlestick folks, sometimes it'll be a morning star, but it's a different requirements than a morning star because it could be the next day or the following day. When you see this occurs, you either buy it at the end of the day or at the beginning of the next day. This is a very strong reversal pattern. A low closed doji occurs in an uptrend when you have a doji, and he has a definition of a doji, which I'm not going to give you, and then you close below that doji bar within X bars. That's a low closed doji, and it's a reversal signal to the downside. The green arrows is a PPS buy and a PPS sell in the red arrow. I'm not going to go much into the pivots. This is his histogram. This is his OBV versus a moving average. My bongos and my indicators. What I'm looking for is I'd like to find stocks that have pulled back to support, that have a PPS buy signal or a person buy signal on the daily, while it's in a weekly buy, and OBV is leading price higher. So I could go into my scanner and tell you right now that that I can make my life easier, that a PPS buy 1 is a buy signal near pivot support when the weekly is in buy mode. So these are stocks that should be sitting, I'm going to make that green, near support, and should have a daily buy on the last bar when it's in a weekly buy. Also was a high closed doji. St. Jude was on my list to be stock of the week. There's a reason why I didn't pick it. Let me go back and look at it. And the reason why I didn't pick it is because it was in such a deep downtrend. I thought it was a lower risk move. I came very close. It's probably a low risk place to buy. And the reason why I liked it on this scan, when I did the scans, was because I've got a PPS signal occurring right near monthly pivot support, which is that blue dash thing here. Okay. I had a high closed doji, I'm in a PPS weekly. I have a PPS daily. OBV is breaking out ahead of price. So I've got higher volume, lower price. That's a convergence. This is going higher. I like St. Jude's a lot. I could look for stocks with high closed dojis on the weekly basis. Let's look at Kellogg's. You'll notice that on my weekly buy list, you're going to find a K for Kellogg's. When I looked at it on a normal chart, it's kind of ugly, kind of loose, broke above the 50, group is strong, technicals are strong, OBV is strong, pays a 2.9% dividend, but what I found interesting about it was it had a high closed doji, so this is a high closed doji scan, occurring with OBV breaking out in a daily buy. OBV looks strong, bongos are green. The reason why I didn't put this as my chart of the week was because it's in a PPS sell signal. So I could scan for PPS buys and sells at support. I can scan for stocks like these that have to be both a PPS buy and on the daily and on the weekly and near support. A PPS 2, let's take a look at it, is daily buy, weekly in a buy. A 1 is a daily buy, weekly in a buy. So 2 is the one that's got support. 3, daily buy near pivot support. So weekly could be a sell. And 4 is anything that's got a daily buy. I could do the same on sell signals. I could look for a sell 1, which would be a new daily sell while I'm in a weekly sell. So Newmont's been in a weekly sell for some time. It's been in a monthly sell for a longer time. And it had a new daily sell this week. And I could look for high close and low close dojis. So I take my stocks and I run them through. Here's some that I liked. This is not my last page. Fix. Why did I like this stock? It's in a weekly and a daily PPS buy. Its OBV on the daily and the weekly are moving higher. It's coming out of a squeeze. There's a reason why I didn't pick this for my chart of the week. And that reason was, that's not why. Volume's 371. This is a beautiful tight chart, lower left, upper right. I did consider this, and I think the reason was because I thought my stop was going to be too far away. But this is one that's in a nice uptrend with lots of pocket pivots. HNT HealthNet. I like this stock a lot for a number of reasons. OBV breaking above moving average here on the daily. OBV retaking the moving average. Daily buy sitting on the 50 and the 200-day moving averages. Weekly it's in a buy. The reason why I didn't pick HealthNet is because it's an arbitrage play. The IBP, this was my first choice and the one I was going to give you. And then I decided not to because of its volume. High closed doji, clear downtrend, new PPS weekly in a PPS buy. OBV turning up, broke above the moving average here. Love the high closed doji on the weekly, but the volume was too low. La Jolla Pharmaceuticals is a specialty pharma biotech type stock that also had a high closed doji here in a weekly and a daily buy. OBV looks strong. It's already had a bit of a run, which would be the negative, but it's coming from a previous high of 45. SFL, Ship Finance, one of these marine shipping stocks that pay a big dividend. You can see a daily buy right here. I mean a weekly buy on a high closed doji. Not daily buy. OBV looks strong. You have to be in a downtrend for a high closed doji. I guess it was in a short-term downtrend, but on the weekly, I'm not sure I would have considered that much of a downtrend. The stock that I picked, let's go take a look at that. So I run all my stocks through John Signals. I scan for John Signals, and I run my picks from HGSI through John Signals. If you're an IBD 50 fan, all right, you've got pick good stocks, how do you know when to buy them? So what I do is I have a scan set up that scans the MarketSmith 250, that scans The IVD 50 looking for new buys. High close doji on Dicom Industries. It's not really a high close doji because it's at a new high. But I'm scanning during the week every night, and then intraday on 60-minute scans, lists of great stocks. Let's get ready to bring this home. I'm getting tired, and I'm sure you're tired of listening to me. So I've talked a lot about John's stuff. I formed a user group, and it's sort of where my two worlds meet. It's the HGSI Pug Users Group. I formed it in June. It's a closed group. I don't charge anything to participate. However, you have to own the indicators in HGSI for you to get any value by it. Anybody that owns both HGSI and is a lifetime owner of John's indicators is welcome to join. If you use his indicators in Genesis and are a lifetime owner, you're welcome to join as well. I just don't support Genesis with the things that I give out. I do, time to time, invite those that have participated in my live programs, paid attendees of live programs, to participate as a visitor. Our goal is to improve our daily trading results by integrating the great tools in HGSI and end-of-day and intraday with the real-time platforms using John's indicators. And if you have any interest, contact me, hgsidoc@gmail.com. Let's talk about my pick of the week and why. I have picked DXCM as my chart of the week for 11/29/2015. It is in the medical equipment and devices category. Had a huge uptrend earlier this year, ending in September, pullback with a bingo testing the 200, which held. It has just broke above the 50. Group strength is strong. You can see it's in a squeeze. The only thing that hasn't turned green is the weekly bongo, which will be late. It did have this past week some pocket pivots and kahunas despite no volume. So looking at this stock, I probably would have bought it on Friday or Thursday, or Wednesday rather, when it had a PSA reversal, but I don't think it's too late. When I stuck it in John's indicators, I saw I had a high close doji on Friday on the weekly with a new PPS buy on the weekly. It's in a PPS buy on the daily. Its OBV is strong on the weekly. It's breaking above its moving average on the daily. It's coming out of a squeeze in both the weekly and the daily. So I see a lot to like here. If the market's stable, I'm going to put a buy in at 89.45, a buy stop. My target is 96.65, which is actually a prior bullish last conditional change. My stop is in red at 82.25, which is the most recent last conditional change. If I'm willing to risk $2,000 on any trade, the risk here is about $7.20 per share, or 8%. I can purchase 275 shares, or if I do options, something else. So I thought I'd talk a few seconds about options. So I'm risking here 2,000 risk. I can own 275 shares. It's about 8% risk on this trade. This is one that I'm probably going to buy it with options. Now, I'm not going to educate you today what an option is. But if I buy a call, I have the obligation, but not the, I have the right, let me say this correctly, the right, but not the obligation to buy the stock at an agreed price. To get that call, I have to pay money for that call. That call has a couple of important characteristics. It has a strike price, which is the price I agreed to buy it for. It has a premium, how much I'm going to pay you to give me the right to buy. And it has a duration, when does my option expire. If I sell an option, it gives I have an obligation to sell you the stock or buy the stock, depending if I'm selling you a call or selling you a put. So buying an option gives me a right, but not the obligation. Selling the option gives me an obligation. I can combine buying and selling options. I can do buy and sell a call, a spread. I could say buy me a call at $90 and sell me one at 100, or sell you one at 100. Selling you that call at 100 reduces the cost that I pay, but it caps my gain at $100. I could buy a put at the money and sell a put to you out of the money or deep. And if the stock closes in between the two, I make money. I cap my loss because I have a put that I bought, but I've also capped my gain as well. So there's ways to combine options in different manners. I use a program called Option Analytics, and it has a tool that allows me to pick my instrument, select the various spread types that I might want to take, pick the date of my expiration, what is the strike price that I want to look at, and then I run the program, and in about 3 seconds, it prints me out. So these are the names of the option play, whether it's long, short, or some combination, what month the option expiration is, the strike prices, whether they're calls or puts, the last price of that option, the bid and the ask. And on the weekend, it's a little bad to do this because the bid and ask get very wide. During the day, it's a lot smaller. The Greeks, which we're not going to talk about tonight. The probability in the money, meaning that probability that the option moves into profitability. The likelihood of me breaking even. The price to break even on the upside or the downside. My maximum risk. My maximum profits. And how much it costs me to get in. Each one of these trades, if it says 1, that's 1 call or 1 put, and 1 equals 100 shares. So if I want 10, would equal 1,000. So for example, on a long call at $90, it's going to cost me about $4.45. So my break-even price would be $90 plus what I paid for it, $4.45. So my break-even on buying the call would be $94.45. Now I can control 100 shares for $445. That means for the $2,000 risk I'm willing to take, I can control about 400 shares versus buying 270. Now, if I own the stock and the stock gaps down 20 points, my stop is not going to help me, and I could lose much more than that $2,000. If I gap down 20 points, my call will become worthless at the expiration date, but all I could lose is that $4.45 a share. So the Option Investment Council would like me to remind you that buying and selling options and other derivatives is risky, and I certainly agree with that, and I agree that you need to have education. But in my mind, a long call is less risky than buying the stock because I have protection against the gap down. I have infinite potential for gains, and all I can do is lose my premium. Now, the stock can do 3 things. It could go down, in which case the value of my call will go down and will expire worthless, meaning lose my 100%. Although I can close my option anytime. It can stay the same and go up the next month, but I still will lose my premium if it doesn't get above 90 or stay above 90 at the expiration or when I decide to sell it. Or it can go up and I can capture the infinite amount of gains. Now I can do a bull call spread where I buy the 90 call, I sell the 95 call. So now if the stock closes above 90, I will make money on my long call. However, at 95, I have to give you the stock. So it gets called away. So I'm limiting my gain to the $5 minus the difference in premium. So it's going to cost me now $210 to buy that spread versus the $445, but I've capped my gains at $290. Now the good news on those trades are much higher risk of winning. My probability of breaking even requires only a $92 versus the $94, but I've capped my gains, which I don't like doing that. There are a number of other maneuvers you could do. How about this one? This is my favorite one, the synthetic long. I buy a call, I sell a put at the same price. It has a P&L exactly the same as the stock. So if I bought 100 shares of a stock at $90, then my risk is that my stock could go to zero. Same risk applies here. So with a synthetic long, it will behave exactly like the stock. So if I'm long the stock, my break even is 88.83. On the synthetic, I actually put some money in my pocket, so I break even at 88.15. My maximum risk is my entire investment. No different on the stock or on the synthetic. My gain is infinite on the stock and the synthetic. On the stock, I have to buy the stock, and in the synthetic, I get paid money to take the trade. So there's lots of different trades here that we can take. The least risky in the trade for novices is the long call, because I get the majority of the benefits at much lower the cost, and I think lower the risk. On the other hand, odds are you're going to expire worthless, which is what you hear all the time about options. Most options expire worthless. I think that's because a lot of people buy protection, and when they expire, it's kind of like your insurance policy you didn't use. A safer bet would be a bull call spread, where you're having less out of pocket and need the stock to move less for you to win on the trade. But there are many different option trades, and I highly recommend you get some option education so you can actually teach me when I'm making my mistakes. But no, the gobbledygook of options is there's a lot to know, which is why there is risk. And you do have many different options, no pun intended. And I use, as I said, option analytics to help me find the one I want to buy. On that note, I'm going to say goodbye and wish you a safe and happy end of year. Hope you had a great Thanksgiving. Hope to see you next year at a live meeting in Florida. And trade safe, my friends. And we'll see you soon. Thanks.